Hello everyone, welcome to the Financial Fitness channel. I am an investor just like probably you, and the following discussion is part of my first conference. This was a recent and unique conference where my intention was to show how inflation really works, what is the mechanism of inflation, so that the attendees can really understand it and prevent the loss of purchasing power of their wealth. Beside that, I wanted to show why gold or even Bitcoin is just a part of my portfolio, and why is it insurance and how to really do that. I try to find the best minds for this, so you will see today the ex-president of the Dutch Central Bank, Professor Lex Hoogduin. He was really honest about the issues and future value of the euro. I hope you will enjoy the following excerpt from our longer discussion. Have fun. It was my honor to talk with him. Okay, good morning.
Good morning.
Hello, everyone. My guest today is Professor Lex Hoogduin, and he has really a portfolio of activities. I would not even start to explain this, but just a few parts of his CV. He is currently Professor of Economics of Complexity and Uncertainty in Financial Markets and Financial Institutions. And he was also the former director of the Dutch Central Bank, also the advisor of Wim Duisenberg. He was the first president of the ECB, and also he worked at the London Stock Exchange. So welcome, Professor. It is my honor that you are here.
It's my pleasure to be here, and good to have me here.
Thank you. And the reason why I asked you for this interview is because in the past, people in Bulgaria and Romania, after their hyperinflations, they had done a new stabilized currency, but the trust was not 100%. So they kept using the Deutsche Mark or the euro. So it was normal that they priced the house, for example, in euros instead of their own currency. And what we see in Hungary currently is that the trust in the Hungarian forint wavered in the last year again because of the weakening, and people started to use euros instead. And this is already interesting, but it is not like the euro is a real safe haven currency. So the Hungarians ran away from the bear behind the lion or something like that. So it would be useful to explain this a little bit further. What is your opinion about the past 10, 20 years concerning that the lower rates led to even lower rates, and the effect of that on our society?
Yeah.
Did the ECB made a mistake? What do you think?
Yes, I think the short answer is yes, but I will elaborate a little bit. So what I think has happened the past decades is that the ECB and also quite a number of other central banks have followed what I would call an asymmetric monetary policy.
Mm-hmm.
So that meant that in circumstances where markets were developing well, they kept interest rates more or less where they were, or increased them relatively little.
Mm-hmm.
Whereas at the moment that there was a problem, where the economy was stagnating or whatever, then they immediately reduced interest rates.
Mm-hmm.
So that means that over the decades we have seen a continuous decline in interest rates, and that has had enormous implications for the functioning of the economy, and has made in the end has made the economy quite vulnerable. So what were important consequences of this asymmetric policy? Well, first of all, it led to an enormous boost to the financial markets. First of all, to fixed income markets, so bonds, for instance, because if you have a structurally declining interest rates, then not only you have the as a return on those investments, the interest rate itself, but also you have capital gains all the time.
Mm-hmm.
So that led to enormous growth of asset managers. We all know the names, the PIMCOs, the BlackRocks. There's an enormous growth of the of asset managers. It also led to favorable circumstances on average for equities and also houses, of course. So it led to inflation of asset prices. And it led to an enormous growth of the size of the financial sector relative to the real economy. And that prompted central banks to focus in their decisions very much on what was happening in the financial sector. And I said that contributed to continuing that asymmetric policy. And so we went all the way down to zero, and even somewhat below it in the case of the of the euro. And that has led again to an explosion of debt, enormous increase in the financial sector, and it has also led to, over time, to the creation of companies and activities that can only survive because of and as long as interest rates are very low, so-called zombie companies. Yeah. That has made as I said at the beginning, that has made the euro area and one country more than another in the euro area very vulnerable to disturbances in the financial sector, to rising interest rates. They're very vulnerable to that, and that has led to the ECB very much trying to focus on trying to increase inflation, because in the past 10, 12 years we had very low inflation. It was relatively stable between 1.5%, 1 and 1.5% most of the time, but it was not to the liking of the ECB. The ECB wanted to push it up in the direction of 2%, and it was not successful in doing that until very recently, and that prompted the ECB to review its own strategy and saying, well, we will only start to raise interest rates if we are absolutely certain that inflation is 2%, and it may even be somewhat higher initially before we start to raise interest rates. So that then led to what I would call a mistake. So recently we had the COVID-19 crisis. The ECB responded in the context of what I would call an asymmetric policy, with an additional program of almost 2,000 billion buying of additional bonds, the so-called pandemic emergency purchasing program. But because, and also government started to stimulate the economy, but the problem was people couldn't spend that money because there were lockdowns and so on and so forth. Then after the lockdowns were over, people started to spend that money. And then inflation went up. On top of that, of course, we had the war in Ukraine, but this already started before the war in Ukraine. So inflation started to go up. The ECB was, as I explained, was hesitant to increase interest rates. So they said, well, this is all temporary, and we have to see through it, and we have to be sure that indeed inflation goes up. So they responded far too late, because it is normal good monetary policy practice that at the moment that an economy recovers and or inflation goes up, that you start to raise interest rates, and they didn't do so. So they started too late, and they're still behind the curve in my view. So interest rates are still stimulating the economy rather than bringing inflation down.
Okay, so that was a long answer, detailed answer. That we are finished basically. Okay, so if I want to summarize a little bit, just to be sure, what you are saying is that so the ECB in this case, how they operated, it is not not only the cause of the asset bubbles, but it's certainly fuel for the asset bubble. And then also in the case of governments, similarly to the central banks, when they had a good time in the economy, they should save a little bit, and they should prepare for the bad times, and they should not run huge deficits. But they did run deficits also in the last 10, 20 years in the good times. And when the crisis comes, then they had even larger deficits. So similarly to the central bank policy. Okay, and so they went too far, and now we have this mess. I don't know how we can get out of it. Probably it will be painful. But is the future of the euro not stable? I mean, what is your current assessment of the euro?
Yeah, I would.
Stability? Because,
My view is that the sustainability of the euro is not assured at the moment. So let me explain it a little bit. We have, in the context of the EU treaty, where the rules of the game of the euro are defined, we have the so-called convergence criteria. And these criteria have to be met by countries that want to join the euro, but they also have to be met on a sustainable basis. So not only on the day that you join the euro, that wouldn't make sense. If then the day thereafter you would say, okay, now everything is fine, you can do whatever you want. So these convergence criteria are important.
Could be important.
Any moment. So these why do we have those criteria, and why are they called convergence criteria? Well, you can only have a sustainable joint currency if your countries are not too different. Because the point is the ECB has only one instrument, that's the interest rate, basically to achieve its objective, which is price stability, and you cannot have a separate interest rate for every country. So the interest rate that the ECB sets is for the area as a whole. So if one country needs a very high interest rate and another very low interest rate, you have a problem. You cannot have one currency. So that's why we have convergence criteria. One of these criteria is that government debt and deficits shouldn't be too high and shouldn't be too far apart. Now this criterion hasn't been met at least since the end of the financial crisis. So the deficits in by now, let's say six, 7 countries at least, are far too high. And I have in mind Greece, Italy, Spain, Belgium, Portugal, and also Cyprus. But these are, take them together, it's a large part of the euro area. It's also, let's say, not newcomers. It's countries that were almost all there from the start. So that puts the ECB in a difficult position. It has to run on monetary policy for the whole area. But as long as interest rates are very low, this is no problem. But if interest rate starts to increase, then there is immediately the threat that we can get a kind of a replay of what we had during the financial crisis, after the financial crisis, the euro crisis, that there will be financial stability problems in the countries with these high debts, which then spread to the euro area as a whole and then threaten, like was the case in 2012, the existence of the euro. So this is a kind of the euro area, let me try to put it vividly, is living dangerously. It has an unhealthy life, and at any moment an unhealthy life can make you sick or even can get you very ill. So this is or if you want to put it more dramatically, it's kind of a ticking time bomb.
And yeah, so, me as a father, or a tax-paying citizen, to define price stability with 2% inflation is a little bit, not correct. Let's see. But do they do these things because they are trapped? So they also need inflation because of the debt, but they cannot increase the base rate. So where do you see the tipping point of this? Well, I agree with you what they should do, but I don't see currently that it will be done.
I think it is correct to say that they are trapped. They're in a kind of debt trap. So they have reduced interest rates lower and lower and lower to a level where, and they could argue all the time that they would do that. They were doing that because of that inflation was lower than they wanted it to be. So there was as I mentioned earlier, a nice consistency for what they thought that they had to do for their primary objective, maintaining price stability, and what helped, let's say, to maintain financial stability, what helped the countries with high debts. But the problem is that at the moment that inflation increases and went beyond the 2%, and not a little bit, but quite strongly, that at that point the ECB has to increase interest rates for its primary mandate. So and that's the only thing that the ECB then has to do. And then there is this tension between the policy that you have to follow for maintaining price stability and and that problem and the financial stability consequences of it, and the potential consequences for the sustainability of the euro. So that explains why, in my mind, that the ECB is acting too slowly, and even now it still is running a policy that is stimulating inflation rather than bringing it down. And my worry is that the ECB is late. So my worry is that the ECB, at the moment that they have reached a level where they think they are neutral, so neither stimulating, neither putting their foot on the brakes, that they will stop too early, and that we will not really see price stability restored, but keeping too high inflation, even according to the ECB's own standards, with all the disadvantages thereof, that the euro becomes a weak currency, structurally weak currency, and that would be a very bad development.
I wanted to ask it later, but what time scale should I imagine for this? So for example, I will have a pension later. What value of pension can I expect this way? Because when I look at history, when countries or regions had this debt trap, they defaulted most of the time silently, so they inflated it away. How do you see this in long term? So it's. Yeah. I ask it now.
It is the risk is that you will indeed see somewhat higher inflation than according to the treaty, and that at the same time the ECB would keep interest rates lower than warranted, and so you get very low real interest
or negative.
And keeping interest rates artificially low, it's called financial repression.
Repression.
Yeah. So what you call silently solving debt problems is most of the time a combination of financial repression to low interest rates and to high inflation. And the inflation part only works to the extent that it's unexpected. And so otherwise people start to catch up. Interest rates will go up, but if the ECB then manages to keep interest rates relatively low, then still it will eat up your pension, at least the purchasing power of your pension. And that's one of my main worries, and that's certainly for somebody living in the Netherlands and having a pension in the Netherlands, because the Netherlands is one of the few countries in the euro area that has a capital-based part in its pension system, and it's simply very difficult to see how you can maintain the purchasing power of such a pension if inflation is too high and if interest rates are too low. That is not sustainable. So that's one of the main worries that I have, given what I just explained, given these high debt levels.
My apologies for interrupting just quickly. If you like this content, please press the like button and share it with your friends on your socials. It costs nothing to you, but it would mean the world to me. It would encourage me to continue and grow this small channel. Thank you, and now back to the video.
And yeah, you said what time scale does that play? That it already plays now. So given the very low interest rates, if you look at Dutch pensions, they were not, in many cases, they were not indexed to the price increases in the past. They were kept stable on a nominal basis. While inflation was relatively low, you could indeed call that a silent process. But over time, many pensioners have seen the purchasing power of their second pillar pension, so the capital base part, go down by 15-20% already over the past 10 years. Now inflation goes up, and we are now in a process that we see that many pension funds are start to compensate for that, but not all of them in full. So you get an increase then in your nominal pension, but the purchasing power continues to decline. So this is not something for 10 years from now, but it's happening now, and it also has an implication for those who at the moment work and don't think about a pension, but they are building up a lower pension in purchasing power terms.
Yeah, I was thinking that we see this now already, the repression part, but how long can it go? Like 10-15 years of this, and then more or less we can normalize it? I was thinking
that's
hard to say.
That's very difficult to say, because it depends on whether citizens, people in the euro area will accept this at some point. Say, well, the ECB should do a job, and if the ECB is not doing its a job, why are we still a member of the euro area? That's a political response that may happen, and that could pressure on the cohesion in the euro area, and then depending on whether the ECB will respond to that, you can draft different scenarios. Your scenario is basically kind of, I would almost say, relatively benign, where very gradually the debts are reduced, like we see now. If you look at the debt levels in the countries, they are benefiting from this inflation that we have at the moment. I'm as I said, yeah, there are different scenarios. I wouldn't call the scenario where it is gradually is reduced. That I think that it may be over, like after the Second World War in countries like the Netherlands. That was a process that took 20, 30 years. There was financial repression, there was relatively high inflation, and still the economy grew. So that also helps to put downward pressure. That is now not the case. So I'm
aging population.
Also, but also a recovery after the Second World War. Of course, a lot of capital goods were destroyed. So that led to economic growth, and that then also reduce the burden of the debt and you increase the affordability of the debt in combination with a low interest rate, in combination with somewhat high inflation, did a trick, as it were, and made it a more or less sustainable path. I'm quite skeptical, let me put it that way, if you can run this type of policies for 10, 20 years without creating huge problems in societies. Because in the end, the inflation will hit the poorest and the middle class, small and medium-sized enterprises. I think already now you see that there is a kind of mood that everybody should be compensated. You can do that 1 year, but you cannot do that for forever. And so I think it is not sure that you can do this in a sustainable way. It's politically very sensitive in the northern countries, because there you could say for the countries with a high debt, there's a quite some benefit, and they don't have capital-based pension funds, but I think for the Netherlands it's I can hardly imagine that you could run such policies in the Netherlands for 10, 15 years, and everybody says, well done, ECB, good policy.
Yeah, I think it can be done because people are not aware of this, and then but we will see. I would prefer
I agree that so far perhaps not, but you will notice in what you can spend.
Yeah, for sure, it must be. Yeah,
and I don't think you can do this in a silent way in an open society like the Netherlands as well. But we will see, because it is at the moment it's going in that direction.
Yeah. I just say that because in real term to decrease this debt burden, I don't see how it can be done in real terms. So it must be inflated away. That's the most easy politically accepted method. How they will do it, how long, we will see.
I think that is too pessimistic, because it has been done. For instance, Belgium has done it in the past. Ireland has done it several times. And why shouldn't it be impossible to do? It will have some short-term price. That's true, but it can be done.
I'm happy for that, and I would recommend another book. This time is different.
Yeah,
it's a good one.
Yeah.
Ooh. Okay, when you said that, countries before did that multiple times. Yeah, this is the history. Okay. And
but for instance, for Ireland, it's very recent history. They were among the countries that had huge problems. Let's say 10 years ago. Look at the situation of the public finance at the moment.
I hope you will be right. And when I think of Hungary, should these new countries like Hungary join the Eurozone, or should they, or Netherlands, for example, should they leave it? Or there are no, or they should say, if we don't get closer to the criteria and there are no consequences, then we leave. Or how should we do that?
So I think a very different question for the
Netherlands and Hungary.
Of course, but let me first focus on Hungary. Of course, if you look at the treaty, then a country that is a member of the EU should join then also at some point the Euro area. It's in the treaty now. Yeah. We know that there are at least 2 countries that
want to join.
Could easily enter the Euro area, but have chosen not to do so. It's Sweden and Poland. And I personally feel that we should get rid of that requirement that you should be forced, as it were, to join the Euro area. I think that should be up to the choice of the countries concerned. If I look at Hungary, I think it's in the end, of course, it's up to, in my view, then to Hungary whether they want to join or not. But I would certainly recommend Hungary not to try to force the pace, as it were. I think it's much better to focus on a stable national currency, restore price stability there, do there what is wise. Because if you join the Euro area at the moment that you just meet the criteria, or just doesn't meet, but politically you are allowed to enter, that's a recipe for problems, as we see every day. So that doesn't help Hungary, and it doesn't help the Euro area.
Yeah.
It's more diverse, and all the types of problems that we already have will only be reinforced. So to put it another way, I can fully understand why a country like Poland says we prefer to be out there. If you take it literally, they are not making the efforts that they are required to make by the treaty. But fortunately, nobody makes a point of that. But I think it would be good that also formally in the treaty we give countries the right to be a member of the EU and to conform with all the requirements in that context, but not to join the Euro. And at the same time, I think that countries that are a member of the Euro area should have the right to leave it. Now, at the moment in the treaty, you can only leave the total EU, and then you automatically leave the Euro area. I find that unfortunate, and I think in the end, for me, let's say the ultimate sovereignty of the country itself is important. But of course, that's a political statement. You could think about it otherwise, and you would be for let's say, going all the way to a political union. That's also a possibility, but I'm not in favor of that, but not on economic grounds. It's more political. I think in the end, I think the Netherlands as a sovereign country should have the right to participate in cooperation, which I'm very much am in favor of, but ultimately should have the right to withdraw from that. Otherwise, you're not you've given up your ultimate sovereignty.
And I also wrote down that, for example, the monetizing or QE program, buying of bonds, but the more and more they do this, then the less effect these tools have, right? And then can you explain maybe why and what happens then? The monetary policy will shift more to the fiscal side, or they have to come up with new tools? Is the CBDC one tool of that? How do you see this? Long question.
Yeah. So first of all, you rightly point at the inconsistency that you have in many countries at the moment between the ECB trying to catch up and trying to raise interest rates, and many countries that stimulate their economy. So we are in a car where you try to put your foot off the gas and then on the brakes, and at the same time somebody puts on the accelerator again. That doesn't give a smooth riding. We have to be afraid, and that's a serious problem. It will make the period over which we have relatively high inflation and where price stability is not reached longer, and it would force the ECB to raise interest rates further. And we have discussed that the ECB is hesitant to do it, so it increases the risk that the ECB will do too little, and that we enter into a phase in which growth will be moderate and inflation too high, kind of a stagflationary environment, which is bad for everybody. But that's the risk that we are driving in that direction. And so QE was in the period where for the ECB you had the fortunate consistency between what you had to do for price stability, driving interest rates down, and what you had to do for financial stability, also keep interest rates low. As we discussed earlier, at the moment, these policies are not consistent anymore. The ECB has to raise interest rates for its objectives, and the more so, the countries keep on putting their foot on the accelerator with all the risks for the financial system, and then ultimately also for the euro. So we are entering a phase of high fragility as a result, and QE cannot be. They cannot apply. The ECB cannot apply QE, justifying it for price for using it for price stability. So that's difficult. And if they still do it, then they themselves contribute to not putting their feet off the accelerator, and perhaps it will need to be to put it on the brake and on the brakes, and so and I'm not sure. If you ask me, I'm simply not sure how determined the ECB really is. So they have said we will normalize policies, bring it to a neutral level. My fear is a little bit that they will define neutral at the lowest possible rate that you could consider neutral. That's 2%. So they will take one increase probably, and then it will be becoming very controversial whether to go further. Certainly, if the economy slows down, which it is doing, but given the fact that governments are so strongly stimulating, it may be that the slowdown will be relatively modest. But still, I'm not sure that the ECB will then be determined to really go beyond the 2% level, and then we are back in where we were earlier this morning in the discussion on what type of scenario are you then entering? That's then the financial repression to high inflation, moderate growth scenario.
Let's say that we have this risk, as you mentioned. Let's formulate it this way, but I hear nowadays a lot that the euro will fall apart at the end. So let's just imagine this path, and then to make it a little bit smoother. So I cannot imagine it will fall apart next week. It's a longer process, but probably at the end it will be coupled to a basket of currencies. We will chop off zeros at the end, or maybe back it with some real value. Or there are other solutions, bringing back the gulden, florin, or there's the Matteo solution. So do you see this in the future, far future, or it cannot happen?
Well, what I think that for me that is not the most likely
concern.
A concern that the euro in its current form is not sustainable. That's a concern that I have. But
yeah.
I think what we will see is that probably we will move further and further in the direction of moving parts of the budget to the European level, financing them through the EC, because you have to be aware that the EC, of course, has only just started to borrow, so it's at a very low debt, so it can increase its debt level without visibly having too high a debt. But of course, it's smoke and mirrors, because ultimately that debt has to be repaid by the countries. But if you keep that a little bit fake, as it has been done with the recovery EU recovery fund,
program.
That I think is a relatively easy way out for governments, and there will be a strong incentive to go in that direction, and so that will make it possible to kick the can down the road somewhat further, which doesn't mean that I totally rule out what I would call an accident where it falls apart. But that then would probably be because citizens in the debtor, in the creditor countries, in the countries with the lower debt, will no longer accept this scenario of financial repression, relatively high inflation, and let's say the ruling parties will lose the majority, and more critical EU and Euro-skeptical parties will take over, and then it can become an uncontrollable process. So I don't rule that out at all, but and it's certainly something that you have to think about. If you ask me what is most, but I would think is most probable at this stage is to continue on that road that we discussed, and then adding to that there will be more and more borrowing at the EC level, without let's say compensating cuts in the national budget. So that will be additional spending financed by borrowing, as a kind of a mechanism for avoiding to make the hard choices.
Yeah, and for our viewers, can you please define the EC? What does this mean?
Yeah, so as we have seen in the recovery fund that has just been after the pandemic, it has been established. There, the European Commission issues bonds to finance those expenditures. So basically, it runs a deficit. It runs a deficit, and at a certain point, of course, it has to repay to redeem these bonds, but also pay interest rates, of course, on it, and that has to be financed by the member states. So, but that is as yet not a precise decision on how to do that. So it's quite vague, and therefore also worrisome.
Yeah.
Also because, as said, the EC itself has a very low debt, even after this 800 billion program. It's still a debt that is very low in percentage of the GDP of the whole EU. So there is a lot of room for issuing this debt, and the market is interested so far in taking up this debt. So it's an relatively easy way out for all the governments that want to spend more but have no room to do so. So that's why I think this will be we will move in that direction further. But there will also be resistance there. Probably, and again, it depends a little bit on how the overall economic development then is, whether that resistance will lead to resistance from the population at large, which then in the end will also lead to politicians no longer accepting it. And that's a difficult to forecast dynamic, but as said, so I think the can will be kicked down that road further probably, but the idea that the euro area would fall apart is something that I see as a scenario that you have to take into account, because I think you always have to take into account scenarios that may be extreme, and I think this is extreme, but it is still plausible. So it's not something that is out of the totally out of the realm of possibilities.
And we should discuss this solution in peace. Not in during a crisis.
Ideally, I think you should sit together and say, well, this the situation where we are in is not compatible with the type of we had in mind, and which is the requirements of which are in the treaty. So what we have to do is either we redefine the type of euro that we want, or we agree on how we can meet the criteria again. And that should be ideally that should be a discussion in which basically there is a kind of negotiation between the countries that fulfill the criteria or have a relatively low debt, and the criteria and the countries that don't, and where the countries that don't will ask, let's say, the other countries to contribute to their problems, and the countries that have no problem will say, well, you should make every effort that you can, because it's initially your problem, and there you should seek a kind of compromise. And if that compromise cannot be found, then you can better find a kind of an orderly way to try to resolve, to unwind it, or go in the other direction, say, okay, let's move to a political union, or at least a budgetary union, where you put all the debt together and reduce national deficits, national expenditures to lower levels, so that you are in a comparable situation to the US, where state budgets are relatively low, so that the state can go bankrupt. So that is also a type of solution that you can discuss. But yeah, we are now on a kicking the can down the road scenario, which, as said, it is like somebody living in an unhealthy way, and hopes that the person that he or she will still live to become old. And for instance, and sometimes that works. There are people interviewed every now and then who are 105 or so and still smoking. But that doesn't prove that it is good to smoke.
Okay, thank you very much. If I look at the timer, we spent a lot of time together. I don't want to take more of your precious time. Thank you very much. It was my honor, and you told really nice answers, and we are a lot smarter through that. Thank you very much.
I hope so, and it was my pleasure.
Yeah, also to me, it was fun. Yeah, thank you very much.